Professor Chester Spatt. He is a faculty member at the Carnegie Mellon University and a visiting professor with the Golub Center for Finance and Policy over the last 2 years. And Chester will talk to us about the structure of equity market exchanges and how it has been evolving over the last 10 years.
Thanks, Leonid. It's a great pleasure to be here, and it's been a great pleasure to visit the Sloan School and the Golub Center for the last 2 years as well. I've learned tremendously from my colleagues at MIT. So today I'm going to talk to you about the structure of our equity markets and some current debates and disputes in those markets, and I've kind of organized this under sort of the broad theme: is the structure of the equity market exchange structure anti-competitive? This is definitely a post-crisis topic. Our capital markets have changed dramatically in the aftermath of the financial crisis, not necessarily caused directly by the crisis, but by regulatory change that went into effect at that time, namely regulation NMS, which basically provided for protection of quotes on markets, but in effect forced the integration of markets to some degree through requirements for fast access and trading. In recent years, there's been debate on a number of fronts, and one of the important aspects of the NMS regime have been fees and rebates that are paid potentially either to liquidity suppliers or liquidity demanders, and we'll talk a little bit about that and how the exchanges are organized. What's the nature of competition between exchanges? Talk about some issues involving cross-subsidization of different pricing of the pricing of different products of the exchanges, and especially the design of pricing tiers by the exchanges. I'll use the analogy to airline pricing and the frequent flyer programs to get across some of the key features of that. We'll talk about the interaction between pricing tiers, data, and co-location, and offer some perspective on why these are interesting and sensible tactics by the exchanges, and link this to issues of best execution. So to begin, let me provide a brief preliminary. The structure of our equity markets is quite intricate in the way trading takes place. The dominant exchanges use a form of pricing called make-take or maker-taker pricing. These involve subsidies to the makers or limit order providers. So the party that provides an order that's sitting on a trading book on an exchange, that party's broker typically receives a rebate, and typically a fee is charged to the party that takes the order or lifts the order. That's the liquidity demander. And the rationale behind this is to encourage liquidity provision, and it's a key way in which exchanges are competing. And it's become a very important tactic by the exchanges. In fact, so much so that when the SEC rolled out the potential for doing a pilot to really examine these issues, the exchanges went to court and currently are contesting the pilot before it occurs. So in the aftermath of regulation NMS, regulation NMS restricted somewhat the maker-taker approach, but it also legitimized it. And what do I mean by that? Maker-taker was already existing before Reg NMS, and NMS said it was okay, but then it sort of limited it. It limited it by saying that the maximum fees could be 0.3 cents per share. So it imposed some restrictions, but it made clear that this was an appropriate and legitimate practice. So that's what NMS did. But NMS didn't say anything about the reverse. And so the markets then started evolving a little bit toward using the reverse, called the take-maker, taker-maker model. Sometimes it's called the inverted model. And so this flips things around. It subsidizes the market orders and charges fees to the limit orders. Now, in principle, should any of this matter? Should it matter whether you subsidize the one side or the other side of the market? And so I'll offer you an analogy. So I have half-season tickets to the Pittsburgh Penguins. Remember, my long-term appointment's at Carnegie Mellon. But I travel a lot professionally, and I can't go out all the games. And especially the last 2 years, I've gone to a smaller proportion of the games during my visit to MIT. So what do I do with the tickets? Well, I sell them. Sometimes I sell them to direct buyers, but sometimes I'll sell them on platforms, and there's actually competing platforms. Now, this is not how the platforms work, but imagine the following hypothetical. Suppose one platform charged the buyers, and another platform charged the sellers. Should I prefer, as a seller, to go to the seller's platform or the buyer's platform? Again, let me be clear. This is a hypothetical. This is not how the platforms work. Well, you might think, oh, I should prefer to go to the platform that's going to charge the buyers because then I'm not going to pay. But of course, no, because the pricing that people are going to offer is simply going to adjust. And as long as the underlying frictions are the same, there should be an irrelevance result. In finance, we sometimes call that actually the Modigliani-Miller theorem. In economics, we often call that the Coase theorem. But basically, there's sort of what I would call sort of neutrality. Now, it's clear, I think, that in the markets, that neutrality isn't the way market participants perceive these things. Certainly, it's not the way the exchanges perceive this, because I think then they wouldn't be all hot about the SEC's efforts to do, in effect, a randomized experiment to kind of understand the impact on the markets. So why do I think that's occurring? Well, I think in part it's reflecting that because the fees and the rebates go to the brokers who make the routing decision, but not to the ultimate customer, there may be some distortion in effect created by the agency issue. In effect, there's an agency issue because the money for the fees and the rebates, that comes from the broker's pocket, but the money for better execution goes to the customer. And because of that distinction, potentially there's a routing distortion. And there's certainly some evidence in the form of routing to platforms that offer rebates, but perhaps poor or slow execution. And this is empirical evidence, and this is what you'd expect conceptually. There's a very nice paper, for example, by Battaglia, Corwin, and Jennings in the Journal of Finance that documents some of this, and in fact names some of the problematic brokers, including some of the big retail brokers. Now, let me be clear. It may be that the customers aren't necessarily getting the shaft, because this may be associated to the extent that the brokers are earning a lot of the extent that the brokers are earning from this practice. It may be reflected in the pricing that they charge the customers, their customers. That wouldn't at all be surprising. And indeed, retail commissions, even going back to the 1990s, have been quite low, and some of it may reflect these types of practices. But nevertheless, there is potentially distortion in routing. And if one wanted to solve that, how could one do so? Well, there's various ways. You could have disclosure. You could outright ban the fees and rebates, or alternatively, you could ban the side pocket. So if the party couldn't slip money, if the broker couldn't slip the rebates into his pocket, that would deal with the agency problem. Alternatively, perhaps enhanced disclosures would work. Maybe more so in the institutional context than in the retail context, and it could be either just enhanced disclosures on the routing practices or on execution costs. These could potentially be very useful. It's not that the industry doesn't understand. The industry does understand, of course, these issues, but the complexity potentially gets in the way a bit of understanding the impact at the individual trade level. So with all this in mind, the SEC unanimously adopted in December a pilot to study tightening the fee caps and whether it should outright ban rebates. And in particular, the SEC proposed a control group, which is kind of the current practice, at 330 mils or 0.3 of a cent, but also reducing the fee cap to either 15 mils or to 5 mils. So either cutting the fee cap by half or by 5/6, or eliminating the rebates altogether and letting the fees adjust. And so there would be 3 treatment groups and a control group. It would be a randomized design. And so the response of the exchanges were not happy about this up front, and the response of the exchanges, in fact, were to file suit. And this may, in fact, speak to a bit of the importance of the agency issues and order routing, because I think under neutrality, if the world was simply described by a neutrality theorem, it's hard to see why anybody would really care so much. And what has happened so far is that the court has set up an expedited briefing schedule, with I think the main briefs due in September, and some observers think that maybe there'll be a ruling by the end of the year. And meanwhile, the SEC has partially stayed the implementation itself, but not the pre-data collection period. So then the SEC took another set of actions that also upset the exchanges. They acted quite somewhat surprisingly, given their history, but somewhat decisively, at least, on issues involving market data. So much of the industry, much of the buy side, and much of the brokerage community are not very happy with the exchange's practices with respect to selling connectivity and with respect to selling data. These fees have have increased dramatically over the years in an environment where, of course, technological types of services have prices declining dramatically over the years. I think of like what percent how does the relative price for the computing that I need compare to other costs, or even like my or even just compensation levels. And it's clearly changed dramatically in terms of declining costs associated with technology over the years. But the data costs from the exchanges have actually increased dramatically. This has been a source of controversy in the industry. And I think especially it's not only the pricing that's been controversial, but the lack of transparency around that. In fact, 24 industry participants, including many, but not all, major brokers and buy-side firms, signed a letter to the kind of petition for rulemaking to the SEC in December of 2017, really calling for more action. And while not in direct response, the SEC declared in October that it would not approve proposed exchange price increases unless they satisfied the requirements of the Exchange Act, and in particular, that the exchanges hadn't demonstrated that their proposals were satisfying these requirements. And what are the key requirements? Actually, the key requirements turn out to be economic, that the prices are fair and reasonable, that they're not unduly discriminatory, that they promote competition. About 10 days later, I don't think by coincidence, I suspect that the SEC, recognizing that there was going to be a public roundtable 10 days later, made sure that they got their opinion finalized. And they highlighted calls, and this public roundtable highlighted the calls for the exchanges to be transparent. And it was almost war between the exchanges on the one hand and the broker dealers and the buy side on the other. But I think here ultimately, I think a key ingredient in this issue is going to be these Exchange Act requirements and how the SEC and ultimately, I think the courts rule about these issues, but this is a long-term issue for sure. I should say a little bit just about the industrial organization of the exchanges. So it's, so on the one hand, exchanges the exchanges do not exercise anywhere near as much market power as they historically did. If you go back historically, there was clear collusion by the NASDAQ dealers till about the mid-1990s, and as actually kind of exposed by a couple of academics, Christie and Schultz, in some very interesting pair of papers. And then it led to the order handling rules and a big settlement big settlements in both class action suit and with the Department of Justice. And the NYSE and NMS, well, I think, NMS has been sort of a mixed bag. One of the important things NMS did is it broke the monopoly of the NYSE specialists. And it did that because NMS required that if you're going to get the benefits of order protection, your quotes had to be electronically accessible. And there was no way that a manual market could basically deliver that. So we don't have that kind of market power, but there's still potential market power by the exchanges. And why do I say that? Well, so a lot of people say, oh, there's 13 exchanges. How much market power could there be? Well, 13 exchanges, yes, but they're owned by, with the exception of the upstart IEX, they're owned by three families, three affiliate families. So the three affiliate families are the NYSE, which owns 5 exchanges, the NASDAQ, which owns 3, and the BAT-CBOE, which owns 4. Now, what can these entities do? Well, in part, the parents can have joint staffing, and they can potentially make they can potentially coordinate pricing decisions across the platform. So you're really getting 3 somewhat independent pricing decisions emerging rather than 12 or 13. Well, IEX is sort of separate, and they're kind of I don't want to say they're sort of a fringe player in a way. Their current market share is 2.6% of all trading. So a little over 4% of the portion of trading that goes to the exchanges. So it's interesting to just reflect for a moment on the nature of competition. There's certainly a lot of tension between, on the one hand, the idea of competing for an individual order versus competing among platforms. So when I arrived I was chief economist at the SEC from 2004 to 2007. So when I arrived there, I learned that there was one word I didn't really know very well. I didn't know quite what it meant. It was called CLOB, but I quickly learned that it was a 4-letter word in Washington. That is, you couldn't say this word, or you couldn't say you supported this word. And in particular, why couldn't you support? Well, because CLOB meant Central Limit Order Book, and the notion was that a Central Limit Order Book, while it would facilitate competition again on the other side of the customer, and from my prior perspective as a professor, I thought all the competition that was important was the competition to be on the other side of my order. But what I quickly realized when I was in Washington was, well, no, that's one important type of competition, but it's also important to have competition among the platforms. That's what encourages innovation in the platforms. And I think more recently I realized, oh, this is like the issue in selling your house. Would you rather that there be lots and lots of people who want to buy your house, but they're going through one broker who has a lot of monopoly power? Or do you want to instead have competing brokers? And in a way, it's a different, and perhaps not so many people on the other side. And it's just a different notion of competition. It depends upon what you're trying to achieve. So let me start to turn to some of the issues involving the fees and the rebates. So the fees are capped at 30 mils, and for the most part, that's what the exchanges charge. The baseline rebates are at about 20 mils, and I'll focus in my talk on sort of the traditional make-take structure, which is still the dominant structure. Baseline rebates are at about 20 mils, but the average effective rebates wind up being at about 25 mils because of quantity discounts that are being provided. Occasionally, in fact, the maximum rebates actually exceed the fees, which of course wouldn't make sense without some degree of cross-subsidization. It's surprising actually that the spread between these is also maybe quite modest. But to illustrate that there's at least a little bit of cross-subsidization, here's some examples of the maximum fees the maximum rebates that were recently quoted, which in these cases exceeds the 30 mil fee. So I thought it'd be instructive to kind of explain a key aspect of the way rebates are structured. There are important quantity discounts. And I thought to give you some intuition about the way in which the quantity discounts work, it'd be helpful to just take a couple of minutes to talk about, of all things, something you're probably almost all of you I'm sure are familiar with, airline frequent flyer programs. So what the airlines, because the features will be very similar in a lot of ways. What the airlines do, at least the major airlines, the American, United, and Delta, the traditional airlines, I should say, they tend to have, they structured their programs, they have 4 award levels. I guess these days, American calls it Gold, Platinum, Platinum Pro, and Executive Platinum or something like that. They have 4 award levels, and they have 2 main paths to get to each. So in effect, there's like 8 pricing tiers. And basically, what the paths involve is some qualifying dollar spending to hit a particular tier, and either qualifying miles or segments. So either you can hit a particular tier if you have enough dollars, and then either enough segments or enough dollar spending. Either way, but there's flexibility. Now, you think, the traditional argument is, flexibility that benefits the consumer. Well, of course not. The flexibility allows the pricing to be more tightly structured. In effect, it allows sort of greater degree of price discrimination. By the way, basically, the design of these programs across the airlines is across these 3 airlines is almost identical. Maybe no surprise. And that doesn't necessarily mean it's anti-competitive per se, so having many paths facilitates price discrimination and surplus extraction. And depending upon the situation, any one of the different variables, qualifying dollars, miles, or segments combined. And I will tell you that late in the year, as I look at where I am, I'll do some calculation to project out what's going to be binding for me and what's achievable for me to achieve and what's not achievable, and how do I want to allocate my activity toward the end of the year. And indeed, I think there's some indication that something like that might even happen in the trading process, that the pricing tiers for the rebates are done on a monthly basis, and toward the end of the month, there may well be changes in routing practice, but it's hard to know because the data about the routing is simply not available. The point is, though, is broadly the status is based upon some kind of cumulative performance. The marginal value might be uncertain early in the period, and either it becomes high or low late in the period, and so the routing practices should change. Now, so how does it work? So that's frequent flyer programs. And to what extent is that relevant to the rebate structure? Well, so a very interesting study by the Royal Bank of Canada, Capital Markets Group, and they find a huge number of pricing tiers being offered across platforms. And several hundred of these, in fact, are in the rebate space. They find a huge number of course, pricing variables being used. They suggest, and others have suggested, that this might reflect some degree of customization in the pricing. That is, that the exchanges might be customizing to some degree to the interests of particular clients, but frankly, it's impossible with the data that's available, which is basically none. In fact, among the data that's not available is how many clients choose which tiers after the fact. Even like last year, how many chose which tiers each month? No data on that. But if you look at the tiers, there's certainly odd features to some of the pricing tiers. Some of them just look weird in terms of, because the definitions of what volume you use, for example, changes. It's kind of like my segment versus my qualifying dollars, but in much more intricate sorts of ways. Now, why might one do this? Well, I think potentially it facilitates extraction and price discrimination, and it may, in effect, be a way to customize. So the pricing tiers are complex. This is sort of not so much of an illustration of the complexity, but just to get you sort of in the spirit of what the pricing tiers sort of look like. So the point here, basically, so these are, again, these are on the NASDAQ's make-take platform. This was an example from about a year ago. The rebates were constructed to add displayed liquidity on the quantity of orders which were adding displayed liquidity and actually executed. And in particular, if the participant was representing more than 1.25% of all of the orders that did that, they would actually be eligible for the maximum rebate, which was 30.5 mils, which actually exceeds the fee. But more generally, you can see, you've basically got deeper discounts. You've got volume discounts, basically, in a nutshell. And that's what this example illustrates. The next example also sort of illustrates volume discounts too, but with some more of the complexity that's really characteristic of the schedules. And so what you see here is you've got a multiplicity of, in this cut of the data, you've got a multiplicity of conditions which have to be satisfied, and to some extent additional conditions needing to be satisfied at the higher tiers, and obviously movements in the threshold as well. So again, it's illustrating the volume discount, but I think now illustrating more of the intricate nature. And part of what I mean by intricate nature is that there's different definitions of the volume, of the basis of volume that are being used. And here's the third example. My third example is designed to make a slightly different point. So, like with American Airlines, there's different ways I could get to the platinum status. And some years, depending upon what my flight pattern is, it might be by having the right segment, by having enough segments, and in other years it might be having the qualifying miles. So the exchanges, they've thought about that too. And so here's a number of ways to get to 29 mils. A bunch of different ways, and in fact, these obviously therefore have to involve some trade-offs. But the point is, again, there's those alternative paths to get to the same rebate. The tiers are constructed on a monthly basis. They apply, it's a little different than so it's slightly different than the airlines. The airlines, they do it on an annual basis, and they do it they look at last year for the next year, basically. Also, they give you the credit even within the year if you make it early. But the point is basically the 2018 behavior determines your status for 2019, essentially, with the airlines. In this context, and in some ways it's a little bit cleverer, maybe clever by half, but the exchanges look at the activity over the month, and at the end of the month, they tell you what you reached, and that determines what the rebate is. So this actually, one of the BuyPrice, so it's contemporaneous. Now, there's sort of advantages and disadvantages, but one of the interesting aspects of it being contemporaneous, this means the broker doesn't know within the month what the impact is, and therefore he can't assign, even if he was so inclined, which he might be inclined, or in particular market competition might force him to pass through, he really can't pass through directly because he doesn't even know what the amount is. So this prevents the broker from immediately rebating back the rebate to his client, or even disclosing it contemporaneously, which would be kind of natural solutions to the problem. And customers, by the way, and kind of in support of this point, the customers even recognize the inability to rebate or disclose contemporaneously. They don't necessarily think of it as maybe this is part of the point, this is part of the mechanism, but it does give the brokers a pass on this at a minimum, and so maybe the agency. So this interacts a little bit in an interesting way, I think, with the agency issue. So this prevents, in effect, just from directly neutralizing the problem, which would be, usually what you'd kind of expect might be a natural solution to the agency problem. In effect, the exchange's interest is served by the agency conflict as it maximizes the broker's incentive. Otherwise, there wouldn't necessarily, otherwise there wouldn't be the ability to price discriminate or serve as an entry barrier. Now, one solution to this that I've proposed, and in fact recently proposed at an SEC Investor Advisory Committee meeting when I was a panelist a month ago, was the idea of constant tiers. That, okay, let's say you don't change the overall structure of the fees and the rebates, you continue to allow them to exist. Still, perhaps we should only allow constant tiers. That would still at least eliminate this aspect of the agency problem. Keep in mind, by the way, you might wonder, why is the payment? Why does it go to the broker? Why doesn't it go directly to the client? Well, why doesn't it go directly to the buy-side firm? Well, in fairness to the exchange client is the broker-dealer. The exchange doesn't even know who the customer is, so there really wouldn't be a very natural way to flow that through. Now, so there is public disclosure of the pricing tiers by the exchanges under the SEC's fair access requirements. But on the other hand, there's no disclosure. So the schedules are disclosed in advance. Although one complaint from some of the industry is they're disclosed at the last minute, sometimes on the last night, and then they're effective the next morning. And so one firm wrote an interesting comment letter a few months ago that basically suggested, well, okay, exchanges obviously they have a need to change prices from time to time, but perhaps they should only be able to change prices quarterly, and furthermore, perhaps they should have to give 2 weeks' notice. And I thought those seemed like interesting perspectives. So there's public disclosure of the pricing schedules. However, there's no public disclosure of which pricing tier a particular broker received, and not even disclosure, even after the fact, of the numbers of brokers receiving a particular tier. So certainly I think this disclosure environment could be enhanced. And indeed, personally, I would probably favor banning the non-constant rebates, even if rebates are retained. So over time, it's clear that more of the revenue of the major exchanges and the parent companies comes from selling data and relatively less from trading. And as you start to think about that, maybe a reasonable way to think about the value of data is proportional to the overall trading on a platform. So it could be that subsidizing trading could make sense because it makes your data more valuable. Now, in economics, there's sort of there's an idea of sometimes referred to as platform theory or two-sided markets. And under that, potentially when you have multiple products, potentially subsidizing one to benefit the other is sort of is an okay thing to do. But here there's 2 other aspects that I think also need to be considered. One is the agency theory aspect, which potentially leads to important distortions in trading and order routing. And the other is the specific requirements of the Exchange Act and what that means. And I think this is something that still needs to be sorted out. The Exchange Act basically says, as I referred to before, that the pricing should be fair and reasonable, not unduly discriminatory, and promote competition. Recently, IEX, which keep in mind is an exchange, but it's sort of the rival and upstart exchange. They were Brad Katsuyama, who's the CEO. He was the protagonist, as perhaps most of you know, in Michael Lewis's Flash Boys about 5 years ago. So recently, they did their own cost study, and they argued that their costs for the data and connectivity were about 5% of the levels that they were paying to the NYSE and the Nasdaq. Now, of course, there's some debate about what assumptions, what are the costs, to what extent can you separate the costs of the data and the switches and the servers and the like from the other aspects of operating the platform. But I think it does sort of provide an interesting perspective and potentially an interesting benchmark. So data is a product. I want to. So here I want to make a point. I want to echo something that Mark Zuckerberg maybe mistakenly said in his congressional testimony about 54 weeks ago. He said that Facebook's data is not owned by Facebook. It's owned by the individual participants. And I think the idea was that the individual participants could withdraw their data. Well, there's sort of some truth to that, but not so much, because they can withdraw their data. But the point is, as long as they don't withdraw their data, it's Facebook that's aggregating the data and figuring out how to sell it. That's where the revenues, of course, come from. And in a way, exchanges are doing the same thing. They're aggregating the data and then having something interesting to sell. In fact, sometimes the folks in the industry say, well, whose data is it anyway? It's our data. But, obviously, there's at least some non-exclusive or joint aspects to this. So the exchanges, there's a variety of data. They one of the key sources of revenue is they sell a variety of proprietary data, like the order books, the dynamics of the order book and the current state of the order book. And they also sell co-location services. They sell connectivity right at their location, so you've got the fastest possible execution. Now, of course, some purchasers of the proprietary data would find the value possibly much greater than others. But the point is basically getting more trading makes your data more valuable. Now, what the exchanges have done, I think very cleverly, is they've set up the data and the fees basically on a fixed basis so as not to discourage activity. That's not really your usual price discrimination model per se. An interesting aspect is the rebate tiering. The rebates, because of the desire potentially to hit the next tier, potentially the structure of rebates where you're getting bigger payments for hitting the next tier potentially enhances the value of connectivity, and so increases the value of their connectivity services, because at the margin those last executions on that platform are especially valuable. This points to, I think, some of the broader dynamics between trading and data and connectivity, that there are important and strong interaction effects. I think my overall view is that the way the pricing is designed, using fixed fees for proprietary data and co-location, reinforced by the volume discounts for orders that are adding liquidity, this is a very clever way to structure things. It facilitates rent extraction and price discrimination. It helps the exchanges attract orders, and at the same time, it potentially, however, also it's a barrier potentially against small upstarts, but it also creates entry barriers even among brokers because of the discounts that the larger brokers get relative to the smaller brokers. Some large liquidity providers actually apparently get even checks from the exchanges net. Clearly, they must not be representative, though. But this may reinforce the extent of discrimination, for example, under the Exchange Act. So the last couple of points that I want to raise are about best execution. So if proprietary data is required for best execution, the exchanges are then in a position to charge even higher prices for the data, as they would be the monopoly supplier. Of course, the data, this like proprietary data, may also just arise not because of regulation, but because of the business need, because your clients demand that you have this data if you're going to execute on their behalf. While investors can execute anywhere, so there's little monopoly power about stock prices, each exchange has monopoly control over the I say here in the slide over data, but really over the fastest access to its own data, but its speed, which is so valuable. So in some ways, maybe it's in the end more important to regulate data pricing even than stock prices. Of course, this is the opposite of where the SEC has been historically. I should say another word with respect to best execution. So the U.S. Treasury, in their capital markets report about 18 months ago, they suggested not requiring data for best execution, except the basic data through the standard industry processor, or SIP. And the reason I think that underlied this view was that the Treasury in the current administration views things from the lens of regulatory cost, and they view requiring the purchase of proprietary data as a regulatory cost, and in effect a source of market power. And I think it's sort of an interesting perspective. I'm not sure that I would agree with it exactly in terms of all of its implications. Now, the SEC actually does bring up an interesting point, though. So what is required? And the SEC has never been very explicit about this. And I think I finally have a rationale for this. First, I always thought, oh, well, that's because they haven't thought through the issue, and that may be. But I think it's also because with faster markets and evolving algorithms, maybe having hard and fast definitions is not such a good thing, and it should be something that should itself evolve. So then in my slides I have some concluding remarks, but I think at this point I'd like to open it up to questions.
Great. A reminder for everyone that the instructions are on the screen to submit your questions to Poll Everywhere. Chester, we have one question from the audience. Does the same anti-competitiveness apply to international exchanges?
So I'm not as knowledgeable about the structure, the structure, but it may well. I mean, I think some of these issues are kind of specific to the way in which aspects of the pricing design are set up. Of course, many countries have a single exchange, and so certainly there would be scope for market power by the exchanges, but I think it would really depend upon the details of the regulatory environment.
Okay, next question. What's the latest status of the IEX's rise? What's your view on the disruption they bring to the industry?
Well, okay. So, so IEX's market share. So first, I think it's, in general, I think it's good to have innovation. I think it's good to have different ways of approaching things. And they certainly have brought a very different model. In their model, they don't charge for data. Some would say that their fees on the trading base, on an individual trade basis, are high. On the other hand, and they don't have these sort of agency issues, and they've also, maybe the most important innovation has been these issues about the speed bump that they have, which sort of delays, which basically tries to deal with the issue of staleness in pricing by creating delays in access to limit the ability to be picked off. So, I think they brought some interesting ideas to the table. Clearly, their market share is not that high, but it has been gradually increasing. It's now up to 2.6%. It's been increasing, but I think there's a lot of upside potential there. I think some of the current regulatory issues, as they get played out, may have a pretty big impact either way. Both these issues involving the access fees on the one hand, and the access fee pilot, and also the issues associated with selling data.
Great. Chester, last question. In your opinion, ideally, where does regulation go next?
So where do I think regulation goes next? So I think, well, in this space, I would say perhaps enhanced disclosure requirements about the pricing tiers, and perhaps even about aspects of the pricing tiers and aspects of the data. I think that's maybe a relatively easy solution. It may also be a move toward constant to requiring constant rebates, assuming that the make-take structure doesn't disappear. That's a harder. I think a more. It's so ingrained in the industry that it's sort of harder to see make-take the fees rebates completely disappearing. But I think constant rebates could be kind of an interesting, at least transition point, but maybe even long-term solution.
We have one final question that came in, sorry. What are your views on growing hoarding of liquidity in dark pools?
So, unfortunately, I'm not so well informed. So, for all my criticisms of the exchanges not being so transparent, the dark pools are frankly even less transparent, which sort of makes it a little hard. And I kind of understand, why. Although in part also I understand why the exchanges want to be not so transparent. I think the less transparent organizations are, the harder it can be to criticize. In my comment, when I spoke as a panelist at the Investor Advisory Committee meeting a month or so ago, I actually most of my comments were about exchanges, and kind of in the spirit that I talked about today. I did specifically also flag the issue of dark pool disclosure and the importance of greater disclosure there.
Thank you.
All right, thank you.